G. Chokkalingam now joins in. Good afternoon, Choka. Not commenting on any particular name. We are at the thick of the results season. Overall, results season, you think is much muted than what was estimated?
Slightly,
for the large cap ones.
Yeah, slightly muted compared to the expectation. But honestly speaking, it's not a big surprise because as we have been discussing for quite some time, the large cap stocks are, suffering from single digit growth syndrome or degrowth mostly, except oil marketing companies and Reliance industry. You have one hand IT companies, pharma companies, and even FMCG, they are having a single digit growth. On the other hand, you have a metal infra degrowth. So, in between then you have private banks which have been fairly doing well. So in this scenario, going is tough, and unfortunately the sentiment also has taken a toll. But however, if you look at the mid-cap space, there are many segments where you still find some growth, whether it is tire company or textile companies. There are many segments where because of the margin expansion, we could see profit growth. So that's why I have been personally focusing almost 100% on mid-cap space for the last 6 months. I would continue to focus.
But that should also be for the last N number of years that you're there in the market, right? That you're always focusing on mid-cap, small-cap, trying to find names where institution holding is zero, and then essentially institutions start to chase this.
Yeah, that is true. I mean, it's not a rocket science, but of course, before giving my thought...
No, I was taking out the statement that you're focusing on the mid-cap in the last 6 months. So I'm saying always you were focusing on mid-cap.
No, I'm coming to that only. What I wanted to say is that, long experience doesn't guarantee the success. I do have one or two failures, massive. But I would like to tell you, since if you can permit me 2 minutes, I would like to elaborate in the interest of the retail investors. The wealth is made only in the mid-cap. And, if you look at it, there are two things. Mid-cap stocks only become large-cap, if they become successful in the business. Once upon a time, even Wipro was a illiquid counter on NSE terminal in the early 90s or mid-90s. You can't find, even if you want to buy 500 shares, those days it used to be very difficult. So, the second, there are a lot of misconception among the retail investors. They think that, illiquid counter is a lot of risk. It is not true. If business model proved to be successful and management is good, what is called illiquid counter becomes highly liquid. The classic example is Force Motor. In 2013, Force Motor went as low as 253. Now it went to, even 3,700. So I just wanted to share this two thought process.
Right. Choka, just stay on with us. I think Arundhati madam is just about to speak. But before she speaks, Choka, just you could tell us SAIL making a loss of 1,000 crores. Tata Steel numbers were not that great. Any sort of view on these numbers? I mean, pointing out towards difficult times?
Definitely, and it is easy to comment. Because, see, the most efficient steel producer like JSW Steel also struggling. They are relatively inefficient PSU SAIL. I don't think, they can outperform the peers. So, metal space itself, particularly the steel, is in trouble. So, it's better to avoid.
Choka sir, can you just tell us that, what do you make of the PSU numbers? 3 big PSU numbers came in today. Bank of Baroda, we saw a big kitchen sinking exercise as the new management came. PNB was okay. SBI quality is looking good, but details of some asset quality is awaited. But still you feel that, we will take some time before we see great numbers coming in from PSU banks?
That is true. I mean, still 2/3 of the PSU banks are untouchable. It's really pathetic. When you look at the banks like Bank of Baroda, Indian Overseas Bank, is really shocking. In fact, I've been tracking banking sector from 93. In 93 itself, I have written a banking on banking stock story. I'm sorry to say, since that time I've been tracking, even in 2003, we did not see this kind of stress from the PSU banks. 2003 was supposed to be one of the worst years in the history for economy and PSU banks.
And that's when after which it really picked up, right?
Picked up. But I have not seen this kind of stress coming, The kind of provisions rising, the kind of, gross level net NPA, even after writing off so much of, provisions. Like look at the Bank of Baroda, the provisions have gone up 112%. Despite that, net NPA outstanding is almost double now. So it's really very scary. It is a high time that government takes hard stand. One, they can go for, consolidation. And they should dilute the stake. I mean, why should the government run the banks and then, worry? People have lent money. Some of the banks have lent money, without even taking into account the risk factors. So this is an item the government should do something about it. Of course, having said that, there are one or two good plays. something like a syndicate bank we like a lot. Net NPA is only 2%. Still the advances are growing 15%. So I would suggest that investors should look at the banks like that in PSU space. I'm sure some of these well managed PSU banks definitely in a year's time they would come back and would create a good return.
Right. Chokka sir, can you also look at the BHEL numbers? Have you looked at them?
I haven't seen September results.
Okay, so I'll just tell you that on an EBITDA basis, they've done a loss of 400 crores. Other expenditure increased by 39% quarter on quarter. There could be a one-off over there, but we don't know. As of now, there could be some written off, some provisions that they've written. Other income was lower on a QOQ basis. That tells that the cash that they have slightly been lower. But execution, that's the sales number, did beat street estimates. What do you make of BHEL? An EBITDA loss despite sales meeting estimate? Does that tell you that commodity prices benefit is not really coming in?
No, more than that, I would tell you that on the same channel we have covered many times BHEL. After seeing the March results, I have been giving sell call on the stock. We discussed many times. The most concern from BHEL is the working capital management.
Right.
If you remember, the inventory and the receivables as of March 31st was 123% of annual sales. That's why after the March results itself, I mentioned that if any company has this kind of working capital pressure, it is very difficult for them to make money. So that's what exactly happened now in the September results. I am sure I have not seen the inventory and receivable as a percentage of annual sales for September 30th ending. I am sure that would not have changed positively. So I would not touch it. I would wait for,
for stocks like BHEL, SAIL that we discussed earlier, the loss figure comes in and suddenly the stock starts to look expensive because EPS cuts would happen, even if it's a one-off or it's not. You think that that's how they start to look expensive every time they declare 3 to 6 months results?
No, unfortunately, SAIL and BHEL, a good management. I have no doubt on that. I have not come across any critical aspect on the management, but the business model per se, they are not comfortable as compared to the private players. SAIL is not at all comparable with something like a JSW Steel. Similarly, BHEL, if you, as I mentioned, the working capital management, it's very tough. Just compare with the L&T. The inventory and receivables as a percentage of annual sales, somewhere around 30-33%. So that is a way to manage the business in the stressful time. So in stock market, you don't have to appreciate all the companies. You will have to really stay invested only in the best efficient place, without losing the valuation comfort. So therefore, even before the results, these two were the sell only. If anybody would have understood the, the balance sheet or the operating margin of these companies, they have been always sell. And you should always, retail investors should go with the best place, provided there is a valuation comfort. And they should not chase these kind of companies.
Right. And, despite the fall over there, it still looks expensive because every time you just keep getting earnings cut. What would be your view on Dr. Reddy's? Again, here, we'll not see earnings cut coming in, but the US pipeline that is there in the future, the approvals over there, that can come in an impact. There are 3 facilities which contribute about $300 million to their revenue, has, seen a significant warning letter coming in. Warning letter is not an import alert, just for our viewers. It is the business goes on as usual, but future pipeline may be slightly under question.
You are right. There will be little pain for at least 6 months. Stock may not perform well, also 3 to 6 months. But one perspective I want to share: if you look at the history of Indian pharmaceutical business, for the last 5 to 10 years, on average, anywhere from 12 to 18 months, most of the pharma majors, they have got the status back. Including now Wockhardt. So what happens, the market reacts, very badly for this kind of news. Of course, there is a negative implication for the fundamentals, but they overreact. But certainly they come back to normal within 6 months to 12 months. And I would suggest that in case it falls another, 3 to 5%, one can even buy it, because considering the management quality of Dr. Reddy, I am sure, within next 12 months to 18 months, they would also, set right everything. And therefore, I would, wait for a little more correction to accumulate the stock.
Right. So another 5% correction, and you would start to buy in parts.
Certainly. We should always buy in parts, because it's a very tough time, the things fall before you finish coffee, suddenly you see some stock falling 10%.
Chokka, I think except 2007, all the times were tough time, right?
No, now it is very tough time for the fund manager. Again, I would like to share, this may be useful for retail investors. In the last 8 years, the role of media has increased because now we have 4 to 5 channels actively tracking every bit of our market, and it has become all, internet based. So the information disseminates instantaneously, and people have got access to execute the trades also thanks to the technology instantaneously. So because of that, now, on downside and upside, you have a huge overreaction. So therefore, now it is a little tougher to have a grip on the fundas and then don't go by the price, because a lot of people go by the price point rather than the fundas. So it's really tough now. For last 3-4 years, this is going to be more tough as you have more and more penetration of the technology, and possibly when retail investors start trading through mobile, it's going to be much more volatile.
Right. Chokka, thank you so much for taking out time for us. Always a pleasure.